What's up everyone, my name is Joris. A question I get asked quite a lot by my clients: should you invest one big lump of money or should you spread your investments over time? Sometimes people receive a big windfall, an unexpected inheritance, you win big in the lottery, or you have received a huge bonus at work. What should you do with that lump of money? In this video we will look at the difference between investing in one time as a lump sum investment or investing over time using the dollar cost average method. So you have accumulated a sum of money. Let's work with 100,000 euros and you do not know what to do with it. Should you go all in the markets or should you invest it over time? And if you would invest it over time, over what period are we speaking? Let's look at the difference between the both ways of investing. If you were to invest a lump sum of money, this could be advantageous because you gain direct exposure to the markets from the moment you are fully invested. Furthermore, your cash that is not invested will have next to no return, especially now with the current trend of super low interest rates. If the markets are in an uptrend, putting your money at work right away will take full advantage of the market growth. And as a last argument, the cost of one big investment will be most likely lower than X amount of times a smaller amount invested. On the other hand, if you choose to invest over time, it is advised to invest at least once a month or even every 2 weeks. The dollar cost averaging method will minimize the downside risk of the big investment. If you have invested a lump sum and after 2 weeks the market dips by 20%, well, you have a temporary loss of 20% of your invested capital. But if you only just started investing and invest only once a month, a dip of 20% will only affect the then invested capital, and it will allow you to buy cheaper shares the next time you invest. This is the second argument. By using the dollar cost averaging, you are taking advantage of the market's natural volatility. You will be buying high, but you also will be buying low. So your average buying price will be different than when you are buying in one lump sum. Buying in every month will also save you from regretting to invest a large sum in the markets in the first place if they would dip. Now, both the theory and the research tells us that lump sum investing is preferable. It will be more rewarding over time to have invested one big sum of money. The longer you spread your investments, the more fear of the markets, more fear of the news or other excuses might come into play and delay or even stop any further investments. In 2012, Vanguard released a study that concluded that in 2/3 of the time, lump sum investments will outperform the monthly investments, the dollar cost averaging. If the market is in an uptrend, investing a lump sum now will be the best practice. By not investing or spreading your investments, you're losing out on potential market gains, while getting a very low return on your stored cash. And do note, this study is done in 2012 in times of high interest rates. Nowadays, this argument is even more strong. I will link the study in the description below, be sure to check it out. Well, the lump sum investing seems nice, but what if markets go down the moment you are invested? Investing is a long-term plan, so there is no way you are getting extremely positive results in a very short period of time. That's why you should always invest with money that you will not need in the near future. But if it still frightens you to invest all in, the dollar cost averaging might be still good for you. You'll spread the risk and you won't have any regrets later. This is mostly an emotional decision. Despite what your emotions tell you to do, you will have to look at the investment from a stoic point of view. Look at the numbers and compare your emotions to the lower expected long-term returns of cash compared to stocks and bonds. By investing over time, you're kinda trying to time the market, something that is really next to impossible. Historically speaking, there are more years with a positive return than with a negative return. This means that staying in the market is more interesting than trying to time the market. Since 1925, there have been almost 3 times as much positive years as there have been negative years. And as this graph shows, the positive earnings in the average positive year are also quite a lot higher than the average negative results in the negative years. Of course, this is the return of every year starting out from January 1st. No one ever invests on January 1st every year. unless you stay invested for over several years. Most bear markets take a few years to recover. In his book Bear Markets May Not Be As Ferocious as They Appear, Mark Hurlbert concludes that the average bear market recovery takes 3.3 years. This study shows that even if you were to invest a lump sum of money, it is not the end of the world. If you can stay invested, time will make sure you come out on top. But if you try to time the market, you'll probably get burned. No one ever gets out of the market on an all-time high or buys in at the bottom of the market. Just stay where you are and you'll be fine in the long run. If you are investing monthly, you'll want to take a look at this graph as well. It shows the yearly returns of the markets as well as the volatility over the year, the highest and lowest points of the markets of that year. It is impossible to pinpoint this lowest and highest point during the year. It's very easy in hindsight, but it's not possible during the year. If you invest per month, this might be the next best thing. You're investing every month somewhere along this line. You'll be buying high and you'll be buying low. But it also means that you might be buying low when the year goes up, meaning you're able to get a higher return than the yearly return. Let's take 1998 as an example. If one of your monthly investments is bought at minus 20% year to date, that particular investment part will have a return of almost 50% that year. Unfortunately, the reverse is also true. You could get a negative return on one single investment, even if the year is positive. But the advantage, when investing per month, an average buying price will be achieved, so volatility will be reduced greatly. So that's all about the pros and contrasts. But what do I tell my clients when they ask me this question? It is very important to me and also to my clients that they feel comfortable with their investments. Most of my clients have limited knowledge of financial markets and only look at the return numbers, which is perfectly fine, of course. That's why they're looking for help for the investments. When they seek to invest a large sum of money, I always explain the difference between the lump sum investing and the dollar cost averaging. For most clients, however, we end up picking the dollar cost averaging method over the all-in method, mainly because of their emotions. They simply do not feel comfortable with investing everything at the same time and are often swayed by the dollar cost averaging method and buying next time at a lower price. This is a typical case where the research proves one is better than the other, but the emotions tells us otherwise. Since a lot of people decide to invest via the dollar cost averaging method, we should also discuss the period of investing. Most of the times we set up plans with my clients between 6 months and 12 months. Any shorter period won't have any impact compared to the lump sum investing, and longer periods will lose out too much on potential gains over time. The most important takeaway here is that the time in the market is way more important than timing the market. I have clients that got out of the market at the end of 2018, fearing a crash was imminent. To this day, they are still full cash, meaning they have missed over 30% in 2019. They also missed the crash in 2020, which they always proudly address when we are meeting. But they are still not invested. They have missed a lot of upsides since then, and they have even missed out on the rally earlier this year. Now they do not want to invest because it's all too expensive now. Those clients have lost at least 20% in return over the 2 years by trying to time the market, instead of just staying in the market. But what should you do when you are looking to invest a large sum of money? First off, take your time to look for a good asset allocation that you are comfortable with. And then decide for yourself what you prefer, the lump sum investment or the dollar cost averaging method. When you have decided, stick to your decision. This is also very, very important. If you choose the lump sum investing, don't just take out your money the first opportunity you get. And if you are dollar cost averaging, don't stop your investment plan. The point is, you are investing, which is already a lot better than just keeping your money in the bank. Make sure your money starts making you more money. And if you still have a positive cash flow from your job or your other investments, keep investing every month to save up a great nest egg that will help you in the future. I wish you the best of luck, and I will welcome you in the next video. If you have enjoyed this video, be sure to leave a like for the YouTube algorithm, and to subscribe to the channel if you've not done that already. It's very easy, it's free, you can always unsubscribe later, but it helps me quite a lot.